a fabulous run in 2019. You got to ask, can the stock market continue to roar in 2020? That's all I heard today. We got two big picture variables here. There's the election and this new situation with Iran. Listen to me. Whether you love Trump or hate him, I know a lot of people on those sides. There's no denying he's been very good for the stock market. I don't want to hear anything different from that. No denying it. This is the most pro-business administration since Reagan. Maybe even the most pro-business administration of my lifetime. On top of that, the Trump White House really cares about the health of the stock market. Some of that's the influence of Larry Kudlow, the president's chief economic advisor, and my former Kudlow and Cramer co-host. At the same time, a lot of people are now very worried about Iranian retaliation for the strike on one of their top generals yesterday. We don't know what they're going to do. Will they close the Straits of Hormuz? Will they attack more oil refineries in Saudi Arabia? Will they storm our embassy in Iraq? Will they restart the nuclear program? But these are a new set of risks that didn't exist even 2 days ago. Now, every year at this point, I like to look at the biggest winners in Dow Jones Industrial Average and the S&P 500, get a sense of whether the rally is sustainable. This year, I'm making three assumptions. First, the election matters to the stock market, and Democratic nominees matter, too. Expect the market to do a lot better in a Trump-Biden race than a Trump-Warren or Trump-Sanders race. Second, I'm betting the economy will keep humming along at a healthy pace that still won't make the Federal Reserve feel compelled to raise interest rates. They've learned their lesson. And third, whatever happens with Iran, it won't be a big enough deal to upend our economy. Could there be some other exogenous event that knocks us off course? Absolutely. But then we do what we always do. When the facts change, we change our strategy. With that in mind, let's drill down on the best performers in the Dow for 2019. Apple was at the top of the heap, roaring 86% last year. Of course, Apple got clobbered in the fourth quarter of 2018, and erasing those losses account for some of this move. But the stock was able to do that because the company did much better than anyone expected, especially after that hideous pre-announcement that occurred a year ago today. Apple's released a string of hit products like the iPhone 11 and the AirPod Pro. I always tell you to own Apple, don't trade it. Still, even I wasn't expecting this kind of success from these new products. I figured the company was transitioning to more of a play on subscription services, which meant the hardware component would become less important. While the subscription business is on fire, turns out the hardware is doing great, too. A lot of it, by the way, is the camera, which is just remarkable. Everyone thinks I'm a professional photographer, even Tim Cook. Can Apple keep climbing? Two firms bumped their price targets big time, although the stock fell almost 1% today, but I think you can definitely go higher. So my recommendation remains the same. I know it's a broken record, but this one's made you a lot of money on it. Don't trade it. The only exception, when the stock runs up going into the quarter, sometimes it makes sense to wait for a pullback. But otherwise, please don't overthink this one. The second best performer, Microsoft, up 55%. Unlike Apple, Mr. Softy's gotten substantially more expensive on a price-to-earnings ratio, now selling for 26 times next year's earnings. But that said, Microsoft's not expensive if you believe Azure, that's their cloud platform, will continue to grow at an incredible pace, while the PC remains strong and the gaming business keeps bubbling up. Microsoft's become the preeminent senior growth stock of this era. I bet it stays that way, and if you watch Wildcard Weekend, you're going to see it all over the place. Third, J.P. Morgan with a 43% rally, fueled in part by the fact that so many other stocks got so expensive that the consistent banks, like J.P. Morgan, deserved a higher valuation. It was relative. In a good economy with the Fed on hold, the banks make sense. J.P. Morgan's got a ton of consistent growth, and this whole industry thrives on the Trump administration's light-handed approach to regulation. Of course, depending on how the election unfolds, this group's prospects could start to look very different, really in play in 2020. Fourth, Visa, up 42%. This remains a fantastic investment, a great way to play the global transition from paper to plastic. It's virtually with no interest rate expense. And without that interest rate exposure, well, this becomes the preeminent fintech stock. Both Visa and MasterCard have nice predictable growth because so much of the world still uses paper. Can you believe it? By the way, paper was up about 6% in 2018. Plus, if Visa gets a real chance to operate in China, the stock could have a lot more upside. Fifth, United Technologies up more than 40%. And this thing is rallying in part because it's merging with Raytheon and getting closer to breaking itself up into three separate companies. There's a real scarcity of high-quality industrials that are worth owning here. United Technologies is one of them. Raytheon's ramping, remember they're merging, because of Iran, like all the defense stocks. There's still one more good reason to buy the stock. But remember, I think the defense move is a little bit ephemeral. It's up so much today. 6, Goldman Sachs. Now, you might wonder how Goldman could gain more than 37% last year with all its growth problems and that Malaysian risk. The answer? Simple. The stock never deserved to be as low as it was. Goldman's in the process of transforming itself, becoming more of a retail-focused outfit that's teamed up with Apple on a new credit card that could soon start delivering terrific numbers. I've done a lot of work on it. It's a great coup that Goldman got this. The stock can't stay this cheap, though, given how much money it can make in an improving global economy. If Goldman gets out of this, Malaysia may last for less than $5 billion, of which $2 billion U.S., $3 billion Malaysia. That's a win. 7th, Nike, which has done the unfathomable, picking up an incredible amount of Chinese business at the height of the trade war. Not even Starbucks can say that. When your weakest market is the United States, that tells you got plenty of upside. Lately, Nike's become more of a tech company. Reminds me of the way Starbucks embraced technology. Makes perfect sense to me that John Donahoe, formerly of ServiceNow, is the new CEO. Just like technologist Kevin Johnson, formerly of Juniper Networks, now runs Starbucks. Hey, you know what? I think the stock can go higher, even though it's up 36.7%. 8th, Procter & Gamble is back. The consumer packaged goods kingpin has figured out how to become a more accountable company while taking back share in emerging markets. Most important, by bolstering its organic growth while managing costs, Procter's been able to generate an earnings explosion. After running up close to 36% last year, I think this thing's got even more upside. Don't forget, Procter's been floundering for years. It only just started to play catch-up. Oh, and remember, the dollar's been down for 9 straight weeks. Fantastic for an international powerhouse like Procter & Gamble. 9, Disney. Last year, the mouse announced a cheap new online streaming service that made the business much less dependent on ESPN. Over the past couple of months, we've seen the results. They're incredible. These days, people are paying more and more for entertainment, and Disney's the last of the pure plays, last of the senior growth entertainment pure plays. Scarcity is a wonderful thing in the stock market. Hey, everybody I talked to on vacation has got has bought the package, including people in the family. Finally, number 10, American Express. With the stock up over 30% last year, I think it's still not compensating you for the immense scale of the China opportunity, thanks to the Phase 1 trade deal that may open their markets to U.S. credit card companies that nobody was talking about because of Iran. Stock simply isn't that expensive, especially if the global economy shifts back into growth mode, as I think it will. The bottom line, look, there aren't enough large capitalization stocks with good growth, bountiful dividends, and big buybacks that really benefit from a stronger global economy. Many of these stocks are in the Dow, and I think these 10 are most emblematic of the upside potential in 2020, as long as the current environment persists, which is exactly what I'm expecting. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.